What if I told you that one of the world's most powerful financial institutions, one that claims to save economies in crisis, has a hidden record of deep damage, broken promises and economic trauma across Latin America? Why did nations once hailed as emerging stars become debt-ridden shells, forced to accept foreign diktats in exchange for survival? And how is the same pattern coming back right now in 2025? That's the mystery we'll unravel today. This is the IMF's dark history in Latin America. We will trace a story not of simple loans and rescues, but of conditional power, structural coercion, and cycles of dependency. We'll go back to the origins, follow the rise, confront the breaking points, endure the fallout, examine failed fixes, and then ask, is history repeating itself? But first, a quick question for you, the viewer. When you hear IMF, do you think rescuing economies or imposing austerity on the vulnerable? By the end of this video, your assumptions may be challenged. Why Latin America? Latin America has often been the testing ground, the laboratory of global financial power, for structural adjustment, conditionality, debt restructuring, and neoliberal experiment. Because of its colonial legacy, its commodity export dependence, its inequality, and power asymmetries with global capital, the region was and remains especially vulnerable to external financial interventions. But before we delve into the controversies, we need to understand how the IMF came to have such influence and why Latin America was a prime target. The IMF mission, Power Paradox, the International Monetary Fund, was founded in 1945, initially intended to oversee exchange rates, stabilize balance of payments, and encourage cooperation. Its origins lie in the post-World War II architecture, alongside the World Bank. Over time, the IMF evolved, or perhaps mutated, into a kind of global central banker for crises, offering what it calls lender of last resort facilities. But with that power came strings. In practice, IMF loans seldom came as blank checks. They were conditional on economic reforms and austerity, privatization, liberalization, currency devaluation, opening to foreign capital. These conditions became known as structural adjustment. Critics argue that those conditionalities effectively became instruments of external control, policy dictates imposed by powerful creditor nations, especially the United States, which holds a disproportionate influence over IMF governance. In Latin America, that power asymmetry was stark. Governments would appear before the IMF, pledging cuts to public spending, deregulation, trade liberalization, even as social needs mounted. As we'll see, the consequences were often devastating, teasing the twist. Not just failures, but patterns. Here's the twist I want you to carry through this story. This is not just a story of misguided loans or bad policies. It is a story of structural coercion and of how external finance can reshape sovereignty itself. And, critically, as new IMF programs re-emerge in Latin America today, we might see the same patterns resurfacing unless a different model is found. Keep this in mind. What may look like a rescue is often a reset of who holds control, who pays, and who suffers. To understand how Latin America ended up under IMF rescue, we must first look at the 1970s, commodity boom and borrowing spree. In the 1970s, many Latin American nations, Mexico, Brazil, Argentina, Chile, etc., enjoyed commodity price booms, oil, minerals, agricultural exports. With those windfalls came capital inflows, sovereign and private borrowing from US and European banks. Many governments took on huge external debt at variable or floating interest rates, confident that commodity revenues would cover payments. External shocks, Interest rates and commodity prices collapse. In the late 1970s and early 1980s, the US, via Paul Volcker, dramatically raised interest rates to fight inflation. At the same time, commodity prices fell. That meant debt servicing costs skyrocketed, while export revenues plunged. The tipping point: Mexico, 1982. On August 12, 1982, Mexico's finance minister announced that the country could no longer service its external debt. That moment triggered the Latin American debt crisis, the contagion and capital exodus. The Mexican default prompted a re-evaluation by banks and lenders. Capital fled from Latin America. Interest rates soared further, and other nations were forced to scramble to stabilize. Thus, the roots of the crisis were structural. Over-reliance on volatile exports, external borrowing under variable terms, global interest rate risk, and then a panic that exposed the fragility of these economies. When the defaults exploded, the IMF entered aggressively. Stabilization programs offered. Starting in the early 1980s, governments turned to the IMF for rescue packages, loans to meet balance of payments shortfalls. But those loans required strict conditions: reductions in government spending, removal of subsidies, currency devaluation, trade liberalization, removal of capital controls. Structural adjustment becomes dogma. Over time, the IMF and World Bank developed a doctrine. Neoliberal reforms would restart growth, attract private investment, fix macro imbalances. Governments were pushed to privatize state-owned enterprises, deregulate open to foreign capital, and cut social spending, IMF as enforcer of discipline. The IMF became more than a lender. It became a policy enforcer. Countries in crisis would remain under IMF surveillance. Disbursements would be contingent on meeting benchmarks. Sovereign decisions were increasingly constrained. Sacrificed social programs. The austerity demanded meant cuts to health, education, subsidies, wage controls, public sector layoffs, subsidy removal, all typical in IMF. Programs disproportionately hit the poor and middle classes. Debt rescheduling and roll over. The IMF often coordinated with the Paris Club and commercial creditors to reschedule debts, extend maturities or roll over interest payments, but not necessarily reduce the principal. The goal was stabilization, not full relief. In effect, many Latin American countries traded sovereign policy space for liquidity and entered a long era of constrained autonomy. Despite IMF programs, the region entered what would become a protracted era of stagnation, unrest, and renewed crisis, la década perdida, the lost decade. The 1980s are commonly labeled Latin America's lost decade. Stagnant or negative growth, hyperinflation, high unemployment, and major declines in living standards, debt overhang and stagnation. Because principal levels were rarely reduced, many countries remained stuck in a debt overhang, where paying interest consumes growth, hampering new investment. Social backlash and protests. The human cost was immense. Austerity triggered protests, civil unrest, political instability, frequent regime changes, and social discontent. New crises in the 1990s-2000s. The 1990s saw a second wave of crises, the Mexican tequila crisis in 1994-95, spilled over to Brazil and Argentina. Argentina's 2001-02 meltdown was perhaps the most severe, triggered in part by IMF-inspired overvaluation of the peso, fiscal constraints and loss of investor confidence, banking crises and currency collapses. In Argentina, Venezuela, Paraguay, and other nations, banking sectors collapsed. Exchange rate regimes broke. Thus, the IMF model struggled to deliver sustainable recovery. Instead, it often prolonged dependency. the very thing it purported to remedy. The effects of decades of IMF influence in Latin America extend well beyond GDP charts. Deepened inequality and poverty. Austerity disproportionately burdened the poor. Cuts to welfare, subsidies, education, and health widened social inequality. Many argue IMF programs entrenched structural violence, erosion of sovereignty. National governments found that policy levers, fiscal, monetary, trade, were increasingly constrained by external creditors and IMF mandates. Political choices were curtailed. Cycles of repeated borrowing. Many countries had to borrow again, entering loops, debt, crisis, loan conditionality, reform. Even as growth remained weak, political backlash and radicalization. In many nations, disillusionment with neoliberalism and external institutions fueled new political movements, leftist governments, populist backlash, anti-IMF rhetoric. Legacy of slow growth. Latin America's average trajectory has often lagged behind other developing regions. Critics point to policy mistakes and external dependence as root causes. Take Argentina as a case in point. By 2025, it has entered over 20 IMF programs, totaling over USD 100+ billion in commitments, yet remains mired in inflation, debt restructuring, and recurrent crises. After decades of turbulence, there have been attempts to reform or circumvent the IMF's coercive model, with mixed success. Brady Plan. 1989. U.S. Treasury. Secretary Nicholas Brady introduced a plan allowing Latin American countries to convert their defaulted debt into new bonds, with lower interest rates and longer maturities, conditional on structural reforms. It was meant to reduce debt burdens while preserving creditor interests. Paris Club adjustments. The Paris Club occasionally agreed to debt rescheduling and later partial relief, but often required conditional reform in exchange. HIPC, Heavily Indebted Poor Countries Initiative. For poorer countries, some in Latin America, the IMF and World Bank created debt relief frameworks if governments adopted poverty reduction strategies. For example, Bolivia got partial relief in 1996. These, however, rarely tackled the root problem: conditional power, unequal governance, and structural vulnerability. Argentina's bold move in 2005-06. In a dramatic move, Argentina under President Néstor Kirchner announced it would pay off the remaining IMF debt, USD 9.8 billion, in one lump sum, cutting the IMF out of its sovereign finances. This was hailed as a moment of assertion against external control, alternative regional arrangements. Latin American nations have explored regional financial institutions, currency swap lines, reserve pooling, or South-South credit to reduce dependence on the IMF. Some are cautious experiments, IMF internal reforms and rebranding. The IMF itself has published critiques, introduced social safeguards, and pushed a narrative of inclusive growth, though many critics argue these are cosmetic changes. Yet none of these fixes have fully dismantled the structural asymmetry at the heart of the IMF-Latin America relationship. This history might seem like relics of the 20th century, but in fact, many of the same dynamics are playing out today. After a period of estrangement, the IMF is back, offering large conditional programs across Latin America, sometimes in the context of post-COVID recovery, commodity price shocks, and fiscal stress. While the IMF claims softer rhetoric, analysis shows many new programs retain orthodox prescriptions: fiscal consolidation, structural reforms, and privatization mandates. Latin America's external debt has surged again. Some estimates show the region's foreign debt reaching $750 billion, carrying high servicing burdens. In 2025, The IMF itself downgraded Latin America's growth estimate to just 2.0%, citing weaker activity in Mexico, global headwinds and tighter financing conditions. In many countries, inequality and poverty remain high, partly due to past adjustment programs. Critics warn that new bouts of austerity could worsen those trends. In Colombia and Ecuador, IMF-backed loans in recent years have triggered further austerity demands, e.g. raising VAT, broadening tax base. Even amid social unrest, conditionality returns. New programs still come with structural conditions, even if cloaked in softer language. Policy lock-ins. Governments under distress increasingly surrender fiscal space, accepting mandates that restrict future policy flexibility. Borrowing loops. Nations borrow to pay debt, implement adjustment, fail to grow, borrow again. Political backlash. Growing anti-IMF sentiment and populist revivals are politically potent again. The danger: we might be watching the same play unfold, a second act of the debt drama, unless the script changes. IMF intervention is not neutral. It reshapes sovereignty. The IMF doesn't just lend, it imposes policy. Its conditionality effectively limits national autonomy, often in ways favoring external capital and creditor interests. Conditional stabilization often undermines long-term growth. Austerity, liberalization, and privatization may suppress inflation or deficits in the short term, but they can erode domestic investment, social cohesion, and productive capacity, trapping countries in cycles of dependence. Patterns repeat, and vigilance is required. The dynamics that produced crisis in the 1980s and 1990s are re-emerging today. Without new approaches or reforms, Latin America risks reliving history. A warning or open-ended thought. Here's the critical warning. If Latin American governments treat IMF programs as a one-size-fits-all cure, they will find themselves constrained, indebted, and vulnerable. The real promise lies not in merely signing loan agreements. It's in reimagining regional or sovereign alternatives, debt restructuring mechanisms that grant flexibility, democratic accountability and conditionality, and development models that center social investment over external dictates. In 2025, as Argentina seeks another IMF program, as Mexico faces weak growth, and as many governments confront fiscal stress, we must ask, will these be the same old deals, or will Latin America chart a new path? If this story matters to you, if you believe finance should serve people, not exploit them, then here's what you can do. Dive deeper. Read works by critics of the IMF. Study alternative development economics. Share this video or your version of it to spark debate. The public must understand the real power behind rescue packages. Support democratic oversight. Push for transparency in IMF agreements and advocate that social impact assessments become mandatory in any conditional program. Stay alert. As new IMF deals unfold in Latin America, don't accept the narrative that they are purely technical or benevolent. Ask who really benefits. Let the memory of past mistakes help us avoid repeating them. Thank you for watching this deep dive into the IMF's dark history in Latin America. I hope this narrative challenges the way you see global finance, development, and power. If you found this illuminating, please like, subscribe, and ring the bell, so we can continue exploring these hidden structures together. In our next video, we'll examine case studies: Argentina's 2001 crisis, Ecuador's protests, and how some countries tried to push back against IMF demands. Stay tuned. Until then, question authority, even the financial kind.